Hello, my name is David. I'm a realtor with Florida Realty Investments, specifically focusing on the Villages itself in Florida, which is a retirement community here. The video you're seeing is from the Villages, and even though I focus on the Villages real estate predominantly, I also keep a close eye on national trends, both to have an idea as to what is unfolding or might be unfolding in our local markets, and also to have some sense of what's happening with the market generally. Even though here in the Villages we are isolated in a sense, a lot of people are trying to move here. They don't necessarily require employment to move here, and that gives the area some insulation from economic turmoil. But the economic turmoil that we're talking about now is going to affect all of us, and I'm talking specifically about what has been happening with interest rates. Now, you may know if you've watched my show before that I look at the Villages real estate market every Monday, and I start by taking a look at what's been happening with the 10-year note, which is the government bond that most closely reflects mortgage rates, since the average mortgage holder only held that debt for 7 years because of moving, selling, etc. This number will probably be increasing in a rising interest rate environment because people will be unwilling to sell and forego their lower interest rate mortgages. And that's exactly the topic of today's show, which is what is the effect of interest rates? What will the effect of interest rates be? And how affected will we be here in the Villages? So now let's take a look at what's happening with interest rates and what's happening in Florida and what this might mean for real estate nationwide and locally here. We're going to start with this chart. Those of you who follow my show know that every Monday I start my examination of the real estate market by taking a look at this yield, which is the yield on the 10-year government bond. On this graph, every bar is a week, and if it's green, then it increased during the week, and if it's red, then it decreased during the week. As you look at this chart, a couple of things stand out. The first and most obvious point is how dramatic the rise has been since April or so of 2020. Rates on the 10-year government bond have basically increased from zero point 0.4 to 4.4. And after some consolidation, they look like they are heading higher as we speak. As a matter of fact, last week, rates increased by almost 0.5%. It would seem difficult for rates to decrease from here with the amount of money the US is having to borrow. And let's actually take a brief digression to point out the risks in holding government bonds during a period of rising rates. And this will also illustrate the risks inherent in owning any asset whose value is tied to interest rates. And real estate would obviously be one of these. We're going to start with something very unusual today. I'm going to show you a price chart, and I will ask you to guess the country after I've described this chart to you. This shows a country that issued a 30-year government bond in 2020, and the bond, which is a 30-year bond, as I said, will mature on May 15th of 2050. When the bond was issued, interest rates were 1.75%, and that's the coupon on the bond. Obviously, the interest payment that the bond makes will remain steady, and the price of the bond will increase or decrease depending on whether interest rates increase or decrease. If you've got a bond paying 1% and interest rates go to zero, your 1% bond is obviously more valuable. If you have a 1% bond and interest rates go to 5%, then your 1% bond is obviously worth a lot less than it was. Now, the question is, which country's bond is this? And the shocking news is this is the US Treasury's 30-year bond maturing 5/15 of 2050. It was issued at around par, which is 100%. It's currently at 48% of par. In other words, conservative investors who lent money to the US government by buying a 30-year government bond 3 years ago are now looking at losses of more than 50% on their US government bond purchase. I looked up information on this bond to get some idea as to how much money has been lost. And looking at this detail, you can see that almost $75 billion was sold in May of 2020. Investors who bought US government bonds maturing May 15th, 2050 are looking at losses of more than 50%. So don't be fooled by thinking that bonds are safe or real estate is safe or any asset is safe. It all depends on macro factors, and it also depends on what unit of measurement you're using. The only reason I bring up this US bond debacle is to give you some idea as to the losses that everybody is facing on assets, whether they're bonds, real estate, or anything else. And now that I've showed you what the effect of rising interest rates has been on bonds, even the highest credit rated bonds, let's take a look at what the effect might be on real estate. People talk about the effect of interest rates on real estate, but I don't think they realize quite how dramatically things have changed just in the last 3.5 years. What I'm going to do is show you information from sources that I will reference in the show notes. You can check my data sources yourself in terms of median home prices, interest rates. There are a number of sources. Down payments, I've assumed 20% down. I take a look at what the situation was in April of 2020, which is about the time that interest rates bottomed. They did bottom actually at below 3%. I'm using 3% for this example. And then the second example that I will show you is how things stand as of April 2023, which is the most recent month that I have accurate data from. So let's start by taking a look at the situation as it existed 3.5 years ago. In Florida, the median home price was $492,560. Interest rates were 3%. If you assume 20% down, your down payment would be $98,512, which would mean that you would be borrowing $394,048. You're borrowing it for 30 years or 360 months. And the results are as follows. Your payment would have been $1,661, of which $985 was interest and $676 was principal. But while these figures are interesting, I suggest that the most important figure is the last figure, which uses the 28% assumption, which simply stated means that lenders will require that your payment total no more than 28% of your income. So as you can see here, $1,661 a month times 12 is 28% of $71,000. What this means is that in April of 2020, the median home price of $492,000 could be purchased by the median household income in Florida, which was just shy of $70,000. So the median household could buy the median price. A number of people have commented on how the increase in interest rates has made houses much more unaffordable, but I think that they are really understating how bad the problem is, because with just a few spreadsheet examples, I will illustrate exactly how dramatic this change has been and why it really bodes badly for real estate nationwide and probably even in the villages itself. We're comparing April of 2020. We're using the median home price of 492,560, and we're using the median income. How had things changed by April of 2023? Let me talk you through what you're looking at here. The changes that I've made to the spreadsheet are: number one, I've changed the median home price. In Florida, the median home price had increased to $785,000, and the interest rate has increased to 8%. What this means is that your down payment has increased from $98,000 to $157,000, and your payment has increased from $1,600 to $4,600. Not only that, your interest has increased from under $1,000 to over $4,000, and your principal reduction has been decreased from $675 to only $420 a month. But by far the worst fact is the fact that the income required has increased from $71,000 to $197,000 a year for a household. One would need a household income of almost $200,000 at today's interest rates to afford the median priced home in Florida. Median price means there are as many homes selling below this price as there are above this price. Okay, you say that's a lot of data, but what does it all mean? There will be a large part of the market that will not be willing to sell because they have below market interest rates. But what they are failing to consider is that the below market interest rate is on a higher priced piece of property than the property will probably command today. So, what you gain with your lower priced mortgage, you're probably losing in your asset value. The real point is, though, if it requires almost a $200,000 household income to buy the median priced house in Florida, what percentage of the USA has the income to qualify for the median Florida house? And the answer, sadly, is under 12%. This pie chart shows you the distribution of household income throughout the US. The largest light blue pie segment in the top is the 200 and over segment. They don't differentiate further after 200,000, but interestingly enough, it is only this segment. None of the other segments are able to qualify for a mortgage for the median priced home in Florida. It's hard to tell exactly what this will mean. Supply continues to be low. Sellers don't want to give up the below market rate that they have. They think that the house is maintaining its value, even though the next buyer, due to higher interest rates, will be paying a much higher price for the same house, even if the current seller sells it for what he paid for it. So ultimately, the problem comes down to this. Are assets going to be protected in an inflationary storm? Is home ownership possibly going to become just a dream for Americans? Is the villages itself going to be affected by this national real estate storm? People generally, and villages specifically, are often sanguine about their prospects. So many people want to move here that we feel we will be unaffected by what happens in the rest of the country. But the problem remains that no matter how badly people wish to move here, if they cannot afford, if they cannot qualify, it's hard to imagine a scenario that does not include either prices coming down dramatically or incomes going up dramatically. I hate to be the bearer of bad tidings, but when you include the increase in the price of homes and the increase in the costs of financing a purchase of a home, the reality is that fewer and fewer people can afford to buy a home, even a median priced home. If you found this interesting, please don't forget to like and subscribe. And I will mention that we produce a show every Monday that focuses on real estate in the villages specifically. And we're adding a second show every week that's going to focus on topics of interest, such as this one. If you're interested in buying a home in Central Florida and you'd like some research done as to what a good price would be for the specific location you're looking at, or you're trying to sell your home and you're trying to maximize your return in a reasonable period of time, please reach out to me at DavidisinFlorida@gmail.com. Be happy to answer any questions you have. Hope to hear from you. Take care.